Understanding financial statements by looking at key ratios. When we compare companies, one of the problems is that companies are different sizes. For example, if you're comparing Microsoft to a software company that only has 3 employees, one of the problems is just the sheer mass of Microsoft versus the smaller company. It becomes difficult to compare because the numbers are different. So one of the things that we do in order to give ourselves a more effective way to look at companies is we can convert financial data into ratios and what we call common size statements so that we can look at things in a little bit different light. There are something called standardized common size financial statements, common size income statements. Basically are an income statement that shows everything as a percent of sales. So the sales number at the top would be 100%, and everything else shows as a percentage of that. It does make it a little easier to compare relative performance of companies, but it's also easy to forget that sheer mass still matters. And so kind of an interesting way to look at a company. Now, one of the things that that is useful is if we're looking within the same industry and companies maybe are similar but maybe slightly a little different in size or even substantially different in size. It gives us kind of a good feel for how they're being managed. One of the things that we can do with every set of financial statements out there is we can use it to create ratios. And ratios basically allow us to do the same thing as the common size income statement or balance sheet, and that is to compare companies on sort of an equal basis. It's useful to look at ratios and compare them not only to other companies but the same company over a period of time and to see how the company has performed. Ratios are used by a very large number of constituencies, both inside and outside of the company, and they come in a number of different categories. Depending on the author, many textbooks categorize ratios slightly differently, but generally there are some ratios that deal with the amount of money that has been borrowed. Sometimes that's referred to as debt ratios, financial leverage ratios, solvency ratios, or liquidity ratios. There's usually a category of ratios that deals with how the company manages itself in terms of inventory and collection of sales, creation of both sales and profit given its assets. Those things are called management ratios, efficiency ratios. Sometimes we call them asset management ratios. There's usually a set of ratios that deal with profitability, and then there are generally a set of numbers that we can look at that have something to do with the company's stock price or value. This is a sample balance sheet that we'll use to work through some examples here. Notice that you have a few numbers to work with. We'll refer back to this with every example. You have accounts receivable here, current assets, fixed assets. Over here you have accounts payable, notes payable, current liabilities, long-term debt. And so you can take a look back here as we go through different examples to compare the numbers. We have an income statement. Same thing, it's an example that we can use as we go forward and look at different ratios. Just note that there are some numbers here. So what we're going to do here is take a quick look at how to compute some of the most basic financial ratios. We'll invite you to pause the presentation on each slide, make sure you understand how the ratio is being computed, and if you need to look back, you can go back to the slide that has the financial data in it, either from the income statement or the balance sheet, and you should be able to see where those numbers come from. So the first category is liquidity ratios. These basically help measure how quickly the company can come up with cash to meet its short-term liabilities. And we have the current ratio, the quick ratio, and something called the cash ratio. You can see here how they are calculated. You also see an example underneath each one if you need to hit pause and rewind to go back to capture the data from the actual income statement or balance sheet that has the relevant information. Feel free to do that. This next category is leverage ratios. We have total debt, debt to equity, and something called the equity multiplier, which we'll use a little bit later. Once again, feel free to hit pause here, take a moment, make sure you understand how each ratio is calculated, and that you're able to look back at the financial statements and see where those numbers came from. This is something called coverage ratios. Basically, in plain English, these ratios offer us a way to estimate how many times over a company could pay certain obligations. So, for example, the one called the times interest earned ratio just kind of tells us, if you look at their company's operating income, or EBIT, earnings before interest and tax, how many times over can the company pay its interest obligation using its operating income. In this example, it's 17.6 times. And you have another variation on that called the cash coverage ratio. You can push pause here and see how these were computed by going back to the example. Some ratios deal with inventory. And here we have a very well-known one called the inventory turnover ratio, which basically tells us how many times in a year do we sell all of the inventory that we have. And then there's a related number here called number of days sales in inventory. Again, feel free to pause and take a closer look. We can calculate ratios that help us understand a company's patterns with regards to collecting money. And here we have a couple of very important numbers. The receivables turnover ratio tells us how many times in a year the company collects all of the money that's owed to it. And in a related fashion, you can calculate the number of days worth of sales in receivables that are sitting out there. And again, feel free to pause and take a closer look. One of the things that we measure sometimes is how effectively does a company use the assets which it owns in order to create sales, something of benefit to the company. And there's one very important measurement called total asset turnover, which is sales divided by total assets. It kind of gives us a feel for, how much sales are being generated by the things that the company owns. Profitability is an important measurement. There are numerous ways to look at profitability. Probably the most basic is by calculating something called profit margin. And that is basically, in plain English, for every dollar that comes in the door in sales, how many cents of that dollar does a company get to keep in the form of net income? Net income, or profit margin is just calculated by taking net income divided by sales. There are some other variations on ways to look at profitability. There's something called return on assets. And you'll notice that it's still net income, but this time you're dividing it by total assets. And we have something called return on equity. And that's net income divided by total equity. So if you have a company that has a certain amount of shareholders' equity, how much net income is being created based on that. It's an interesting thing to consider. Feel free to hit pause and go back and look at where these came from. It's sometimes helpful to look at a company from the standpoint of an investor marketplace. And so there are some really basic numbers that you should be familiar with. The most obvious one of them is the share price. For publicly traded companies, it's just the current price to buy one share. Usually, you can find information on how many shares there are outstanding. And there's one really important ratio called a price-earnings ratio, or oftentimes known as a PE ratio. What they do there is they take the price of one share of stock and divide it by the earnings per share of that stock. And it gives a relative feel for valuation. Is a stock overpriced or underpriced? And sometimes when we have the discussion of overpriced or underpriced, meaning, is the stock relatively expensive or relatively cheap, usually what they're talking about is the PE ratio. It's an important number to understand and know where it came from. We have here just a quick summary. Feel free to hit pause if you'd like to get a closer look at how to compute some of the more basic ratios. Now, there are several hundred ratios out there that can be used. These would be some of the most commonly used ones right here. And the way that they're organized is fairly common, although you may see variations on that depending on textbook authors and opinions of others who are writing about them. One thing that should be mentioned is an important analytical tool called the DuPont identity. We'll cover that here briefly. The basic premise behind the DuPont identity is understanding this number called return on equity. And we told you that return on equity was calculated by dividing net income by total equity of the company. And what it really means is, let's say that the shareholders own a certain amount of net worth in the company, how much profit is being generated from that. One of the problems with the return on equity number as it's calculated right here on the screen is even though you can compute the number, if there are changes over time in that number, let's say you examine a company's return on equity over a 5-year period, one of the things that we're not able to determine is if there are changes, where did the changes come from? What has changed inside the company that makes things different? So there is this other methodology called the DuPont identity, and mathematically, if you rearrange the terms, what you discover down here at the bottom is that return on equity can also be calculated by multiplying these three terms together. So let's take a look at what those are. We would say return on equity can be calculated by multiplying the profit margin of the company times the company's total asset turnover times something called the equity multiplier. And each of these three things represents something important to the company. Profitability obviously relates to how efficiently the company is operating from the standpoint of, is it keeping its costs down? Are sales holding up? And those types of things. Total asset turnover talks to us about how effectively the company is using its assets. And this thing called the equity multiplier tells us about the company's borrowing, how much financial leverage is involved in the company. So the DuPont identity gives us an interesting way to look at a company's return on equity and have some idea where changes might be coming from. If you calculate the return on equity using these three variables and you realize over time that there have been some changes to return on equity, you probably can look at the variables and find out where those changes occurred. And you might find out that the company's return on equity, for example, maybe has gone down, and maybe a closer examination would tell you that the profit margin has decreased. There's just something's not quite right with the profit margins, and so that gives you a place to begin an investigation to learn a little bit more about why those changes may have occurred. By definition, we're going to talk very quickly, there's something called a dividend payout ratio. That simply means if you look at the company's profit, how much of it do they decide to pay out as dividends and how much does not get paid out. In the example here, dividend payout ratio of 39.63% means that the company paid out 39.63% of the total profit in the form of dividends to the shareholders. The reverse of that is something called the retention ratio. In other words, how much did the company decide to keep of its profits rather than giving it to the shareholders. We'll use this momentarily when we calculate something called the internal growth rate. This is another interesting financial tool that can be derived from looking at financial statements. And growth rates basically give us some idea how quickly a company could possibly grow depending on a couple of different factors. Internal growth rate means how fast could the company grow only using its retained earnings to fund growth? So in other words, they're not going to go out and get any more money in the form of borrowing. There's a simple way to calculate it. This is a tool used to help estimate or forecast for a company. We would simply say that you would take the return on assets of the company times the retention ratio, represented by the lowercase letter b here, and divide it by 1 minus the same number. So in this example, we would estimate that the company could grow at about a 6.7% rate just by using retained earnings to finance its own growth, and it won't overextend itself. There is another way to look at projected growth rates, and that's something called the sustainable growth rate, which basically means how quickly could your company grow if you used your retained earnings and you also borrowed money at a rate that kept your debt ratio the same over time. So rather than just keeping the same amount of debt and gradually paying it off, you would continue to borrow so that debt represented the same percentage of your total capital structure over time. The basic idea here being, rather than just using profits and retained earnings for growth, you would also be willing to borrow a little bit to keep your ratios the same. Under this model, you would be able to grow at 17.92%, which is substantially higher growth rate than the one that we looked in the prior slide. So there's a couple of interesting tools, interesting things that we can think about and use as forecasting tools and analytical tools. They all come from the basic financial statements. You know, growth is usually tied to one of these things. How efficiently does a company maintain its profitability? Does the company choose to borrow? If the company does choose to borrow, sometimes that accelerates growth. How effectively do we use everything that we have? So these concepts all tie in very closely with some of the things that we've just been talking about. We summarize for you right here the formulas for calculating internal growth rates and sustainable growth rate.